Hello everyone, welcome to the market opening bell for Wednesday, February 25th, your 10-minute guide to the stock market. Hong Kong stocks followed the weakness in overseas markets. The Hang Seng Index opened 168 points lower and the decline widened during the session, falling as much as 601 points to 26,480. It eventually closed down 491 points or 1.8% at 26,590. The Hang Seng China Enterprises Index dropped 189 points or 2.1% to close at 9,007 points. The Hang Seng Tech Index fell 114 points or 2.1% to 5,270. Total market turnover for the day was 250.9 billion Hong Kong dollars. Southbound Stock Connect funds recorded a net inflow of 3.131 billion Hong Kong dollars into Hong Kong stocks. Among them, the net bought $1.585 billion of CSOP Hang Seng Tech Index ETF, 687 million of Meituan, 437 million of Xiaomi, 304 million of Kuaishou, 242 million of Ubi Tech, and 220 million of SMIC, while they net sold 205 million of PopMart. According to statistics, Southbound funds have been net buying Meituan for 5 consecutive days, totaling $2.623 billion, and have net bought Xiaomi for 3 consecutive days, totaling $2.668 billion. After the long Chinese New Year holiday, the A-share market resumed trading on its first day and opened strongly in positive territory, with the 3 major indexes rising and extending gains in the morning before slightly moderating in the afternoon. The Shanghai Composite Index rose 35 points or 0.9% to close at 4,117. The Shenzhen Component Index gained 191 points or 1.4% to 14,291. The Chinex Index increased 32 points or 1% to 3,308. Combined turnover in Shanghai and Shenzhen reached 2.1986 trillion yuan. The renminbi central parity rate against the US dollar was set at 6.9414, down 16 pips from the previous day. Yangtze Optical Fibre and Cable A-share hit the daily limit up, with its share price reaching a new all-time high. The stock has surged 102% year-to-date, pushing its A-share market cap to 194.3 billion yuan. Its A-share counterpart, Yangtze Optical Fibre and Cable, rose as much as 6.5% intraday to $136, also hitting a record high, up 163% year-to-date, with its A-share market cap exceeding 110 billion Hong Kong dollars. The surge is driven by strong demand for optical fiber amid the AI boom. According to CRU data in January 2026, the spot price of domestic G652D bare optical fiber rose 79% month-on-month and 92% year-on-year, with cumulative gains exceeding 100% since May 2025. In early February, Yangtze Optical Fibre stated that it had noticed heightened market attention regarding supply-demand dynamics and price fluctuations in telecom optical fiber and cable products, as well as products relating to computing power data centers. The company reminded investors that the overall global optical fiber and cable market environment remains normal, and that demand for new data center-related products still accounts for a relatively small portion of total global demand. Investors are advised to be mindful of investment risks and make rational decisions. China Tourism Group duty-free A-shares hit the daily limit down, while its X-shares plunged more than 10% to 82.2 Hong Kong dollars. The main negative factor was the loss of operating rights at Shanghai Airport, combined with disappointing Chinese New Year data and a valuation correction. The company's 2025 earnings forecast shows a year-on-year decline in net profit attributable to shareholders of over 20%, with earnings recovery slower than market expectations. Recent legal disputes over U.S. tariff policies and potential future trade changes have also affected market expectations for the price differential between duty-free and taxed goods. Analysts note that if global trade policy stabilizes, the relative price advantage of duty-free channels may weaken, thereby impacting China duty-free's valuation logic. Hong Kong-listed film and entertainment stocks fell sharply. Mai Entertainment plunged 6.7%, while Maoyan Entertainment dropped 8.2% as of 10 a.m. on February 23rd. The effective box office for the first 6 days of the 2026 Chinese New Year period, Lunar New Year's Day to the 6th day, February 17 to 22nd, total 5.077 billion yuan, down 38.7% compared to the same period last year. The full period box office is now expected to fall below the previously forecasted range of 6.5 to 8.5 billion yuan, mainly due to the lack of standard blockbuster films against a high base last year. After the Hong Kong market closed, Maoyan Entertainment released a positive profit alert, expecting 2025 full-year profit to be between 540 million and 590 million yuan, representing a 196.9% to 224.4% increase from the previous year. Revenue is expected to be between 4.6 billion and 4.7 billion yuan, up 12.7% to 15.1%. This is in stark contrast to the first half 2025 performance, which saw profit drop to 175 million yuan due to market volatility. The strong performance was mainly driven by several films that Maoyan controlled and produced, performing exceptionally well in the second half of 2025 and during the year-end period. Additionally, the national performance market GMV hit the record high in 2025, with Maoyan's live performance business growing far above the industry average, and its overseas self-operated business also achieving breakthrough growth. However, in the movie ticketing market, the duopoly between Maoyan and Tao Piao Piao is already established, leaving limited room for growth in ticketing service fees. If film producers cut their budgets, revenue from entertainment content services, advertising and promotion will be directly affected. As a company deeply involved in film production and distribution, Maoyan's quarterly profits can fluctuate dramatically depending on the success or failure of major films. Moreover, its performance is heavily dependent on the three major holiday periods: Chinese New Year, Summer, and National Day. If scheduled films are delayed or face strong competition, it could face impairment risks. The film and entertainment industry generally has long receivable cycles, and in an environment of tight capital chains, there is still a need to watch out for large credit impairment losses. In addition, although the 2025 performance market GMV reached a record high, competition from rivals such as Mai and Mo Tianlun remains intense to secure exclusive ticketing rights or invest in popular concerts. Maoyan may need to pay higher upfront payments, increasing capital tie-up pressure. Standard Chartered Group announced its results at midday. Last year's pre-tax profit on a reported basis reached $6.963 billion, up 15.78% year-on-year. The basic return on tangible shareholders' equity reached 14.7%, achieving the 3-year target a full year ahead of schedule. However, fourth quarter pre-tax profit on the reported basis was $810 million, up only 2% year-on-year, missing market expectations. Net interest income in the fourth quarter declined due to the interest rate environment. The full-year net interest margin dipped slightly to 2.03% from 2.06% in 2024. Wealth management performed strongly, with income rising 24% year-on-year, benefiting from asset inflows from wealthy clients in Asia and higher sales of investment products. Standard Chartered's Hong Kong commercial real estate loan exposure remains low at $1.5 billion in the fourth quarter, down 17% quarter-on-quarter and 42% year-on-year, accounting for less than 2% of the total loan portfolio. According to the bank, the average loan-to-value (LTV) ratio is below 50%, indicating a resilient and healthy position. The group proposed a final dividend of 49 US cents per share, a 1.3-fold increase year-on-year. The full-year dividend per share rose 65% to 61 US cents, beating expectations. The group also announced a new $1.5 billion share buyback program. For 2026 guidance, the bank switched to a reported basis, expecting operating income growth in the low end of the 5 to 7% range, with net interest income expected to be roughly flat year-on-year. Reported costs are expected to remain stable, reflecting the final year benefits from the efficiency and productivity plan. Regarding the recent sudden departure of CFO Diego De Giorgi to join Apollo, although it put short-term pressure on the share price, management stated that it does not affect the established strategy. Technical analysis, the Hang Seng Index filled the upward gap from Monday between 26,694 and 26,796 points, reaching a low of 26,480 and approaching the 50-day moving average at 26,456 points once again. Today is expected to rebound following the U.S. market, but the 10-day moving average at 26,842 points is likely to act as resistance. After Monday's sharp sell-off, U.S. stocks rebounded strongly on Tuesday. The fear gauge VIX index fell 0.2 points or 1.1% to 20.8. The Dow Jones Industrial Average rose 370 points or 0.8% to close at 49,174. The S&P 500 gained 52 points or 0.8% to 6,890. The Nasdaq rose 236 points or 1% to 22,863. The Nasdaq China Golden Dragon Index, which tracks Chinese concept stocks, climbed 102 points or 1.4% to 7,581. Meta reached a deal with AMD for AI chips and invested in AMD through performance-linked warrants, with the potential to subscribe up to 160 million shares. AMD share price closed nearly 9% higher. Nvidia rose 0.7% with its earnings due to be released today. After falling 13% on Monday due to AI concerns, IBM rebounded nearly 3% on Tuesday. Software stocks also broadly recovered, with the iShares expanded tech software sector ETF rising nearly 2%. Home Depot reported that its fourth quarter net profit fell 14% year-on-year to $2.57 billion. Adjusted earnings per share came in at $2.72, beating market expectations of $2.53. Sales declined 3.8% to $38.2 billion, also beating estimates. The stock rose nearly 2%. The company stated that economic uncertainty, high interest rates, and a stagnant housing market continued to weigh on home improvement activity, dragging down profits last quarter. Same-store sales grew 0.4% during the quarter. The company reiterated its fiscal 2026 guidance. Same-store sales flat to up 2%, with adjusted earnings per share flat to up 4%. Warner Bros. Discovery said it has reached an improved acquisition offer from Paramount Sky and will review the new bid in accordance with the terms of its existing agreement with Netflix. If Warner Bros. Deems Paramount's new offer superior, Netflix will have 4 days to raise its previously agreed acquisition price. The conference board released its preliminary U.S. Consumer Confidence Index for February, which rose 2.2 points to 91.2 as consumers' pessimistic outlook for the future eased somewhat. January's figure was revised upward to 89, according to ADP data. In the 4 weeks ending February 7th February 7th this year, U.S. private employers added an average of 12,750 jobs per week, marking the 4th consecutive week of accelerating employment growth. Federal Reserve Governor Cook stated that artificial intelligence has triggered a generational shift in the U.S. labor market and may lead to higher unemployment rates, while the central bank may not be able to address this by cutting interest rates. Our stock pick today is Link REIT, stock code 823. Link REIT announced an interim distribution of 1.2688 Hong Kong dollars per unit for the period ended 30th September 2025, down 5.9% year-on-year. This was primarily due to a 1.8% decrease in revenue to 7.023 billion Hong Kong dollars, with total distributable income falling 5.6% to 3.283 billion dollars. The full-year distribution forecast is $2.64 per unit, representing an approximate 3.1% year-on-year decrease. At the current price, this translates to a dividend yield of nearly 7%, which is higher than the US 10-year Treasury yield and most major Hong Kong blue-chip stocks. The stock remains attractive for investors seeking passive income. The current share price is trading at a substantial discount to its net asset value of 61.19 Hong Kong dollars, with a price-to-book ratio of approximately 0.6 times, near historically low levels. As of 30th September 2025, the net debt ratio stood at 22.5%, with both the US and Hong Kong entering an interest rate cutting cycle. Financing costs are expected to decrease further, which should support higher distributable profits going forward. Regarding its Hong Kong retail business, Link REIT continues to proactively optimize its tenant mix in Hong Kong, including introducing more mainland Chinese brands that have expanded into the city. The company is also focusing on the steadily growing education sector, such as learning centers and interest classes, as well as fitness and family entertainment venues. Regarding asset enhancement, the company completed AEI projects at Lee Yu Mun Plaza and TKO Sport during the first half of 25-26 financial year, investing 59 million and 21 million Hong Kong dollars respectively. These projects are expected to generate attractive internal rates of return of 14.5% and 29.1% respectively. In addition to these major projects, multiple smaller scale enhancement works are being carried out across the Hong Kong portfolio, particularly by reconfiguring selected areas to improve layout efficiency and increase productivity on those floors. Regarding its office and community assets, despite higher vacancy rates in Kowloon East office buildings, the waterfront office property held through a joint venture maintained an exceptionally high occupancy rate of 99.6%. Construction of the community commercial asset Ling Da Plaza at Anderson Road is progressing smoothly. The project, with a gross floor area of 12,936 square meters, is on track for completion in financial year 26 2006 to 2007, and pre-leasing activities have already commenced. Link REIT's mainland China portfolio comprises 6 retail properties, 1 office building, and 5 logistics assets located in Tier 1 cities in the surrounding Yangtze River Delta and Pearl River Delta regions. As of 30th September 2025, the occupancy rate for the mainland retail portfolio remains stable at 95.9%. To tackle market challenges in the mainland, the company has been adjusting tenant mixes, notably at Beijing Zhongguancun Link Square, and securing major tenants for Link Enterprise Square. Major asset enhancement projects at Guangzhou Tianhe Link Square and Beijing Tongzhou Link Square were completed, delivering IRRs of 10.7% and 10% respectively. Several smaller projects were also finished, including space reconfiguration at Link Center City and Guangzhou Liwan Link Square, renovation of floors 4 and 5 at Shanghai Qibao Link Square, and enhancement of the basement area at Beijing Zhongguancun Link Square. These smaller projects achieve an average IRR of 9%. Occupancy at the Shanghai office asset remained stable at 96%, while the 5 logistics properties recorded an average occupancy rate of 96.6%. Regarding its overseas portfolio, retail properties in Australia and Singapore continue to deliver strong occupancy rates of 98.1% and 99.8% respectively. Going forward, the company will focus on exploring growth opportunities within its Australian and Singapore retail portfolios to further diversify its overall investment mix. Investment recommendation: buy-in price $37.5, target price $41, stop loss $36. I do not hold the stock mentioned above.